Mike Muller, head of Vitol Asia. Mike, a month into this year, after a lot of things in January, can you identify, is there clarity yet, or how do you see the first month?
When you say clarity, relating to how
Well,
Russian products can continue to flow
Well,
under the
let's
various
get to
measures?
that. Now, I mean, I'd
Right.
say more clarity in a broader sense of the direction of travel of the market. I mean, we've been started 80, nearly went up to 90, we went back to 80 again. It
Yeah.
looks like a slightly confused January. My question is, do we now have some clarity of direction?
Yes, I think the various forces that should determine flat price will be the resumption of demand from China, which we talk about every time we get together here. Whether or not the latest set of measures relating to Russia from the EU, the US, and the UK will impact output, exports from Russia in any way, or their arrival to market, which is a different thing. And of course, then there's the balancing mechanisms in the market also. This week elapsed is probably the week when there was least airtime on an OPEC Plus meeting, sort of been relegated in people's minds to maybe third spot in that equation. And then, of course, overriding all that is the concerns about global slowdown and the strong desire amongst OECD economies to keep the cost of raw materials in check, given that we've probably been able to label 2022 as a cost of living crisis. And then the final and fifth factor, I guess, is the weather, which has led to major relief on the natural gas and therefore utilities bill cost front in Europe, and taken that pressure off, which 2 or 3 months ago we would have all said would have been the number one preoccupation of markets and politicians.
Just sort of starting on that sort of embargo question, I wanted to start at it through China. 2 months into the China abandoning its zero COVID policy, are we any clearer as to the momentum of economic recovery? Because in a lot of ways that could determine whether the embargo on Russian products creates a shortage or not. Because as long as the Chinese are exporting lots of products, the market seems well supplied. But if the Chinese economy gets going again and starts restricting its exports because it starts consuming more of its products, then we could have a shortage. How do you see those dots connecting?
Yes, you've touched on some really important pieces of the jigsaw here for 2023. Yes, we do have the data now for the Chinese Great Migration, as they call the Chinese New Year, which was so much earlier than in previous New Years that you need to normalize the data. But January was a bit of a funny month because of the slow start in the Western Hemisphere with New Year, and then the big Chinese New Year holiday from the 22nd, which basically the last day of the Chinese New Year fortnight is today. So that migration showed some rather interesting things. The government's forecast numbers in the first year in 3 years that the government had not urged the population to refrain from traveling to see their loved ones in their hometowns, saw public transport utilization somewhat fall short of the predictions from the government, but private vehicle voyages are way up above 2019. And that's partly a fact of the growing middle class in China and having more cars at their disposal, but it's also a sign that people still prefer to be in their own private transportation space than on public transport. The toll that letting the virus run in China was expected to take is obviously going to be very difficult to fathom, but I think the death toll and the hospital shortage concerns people had have not eventuated, as many Western commentators would have predicted in December. And that's certainly good news for China. And now for February, we have the first full month of normality where we have to see how things bear out. But there is a pretty upbeat feeling about China. And you can only point to certain pieces of evidence. China has the capacity, both in refining and certainly in petrochemicals, to run a lot harder. And if you look at the behavior of the major Chinese protagonists, they certainly accelerated their purchasing, which is a trend that started in December of crude oil, which is the start of that chain that then feeds the refining, transportation fuels, and petrochemical side of the equation. And I think that has given the market quite a lot of confidence that China intends to run hard. and to have the availability of products to cover the eventuality you predict there, Sean, that they might need more domestically than they thought.
Pick up on that, Mike, your thoughts, because the added part of that puzzle is also the fact that the big US refineries going into maintenance, having sort of delayed that given the bumper profits to be had last year. So with the refining maintenance season coming and this situation in Russia, that's a lot more crude that isn't being turned into products. And so, yeah, maybe that is a reason to see Brent dip below 80. Your thoughts on that?
Yes, tricky there, Sean. I mean, I think it is a fair observation that refining margins were such last year that any maintenance that was discretionary, it could be pushed back into 2023, was pushed back. So therefore, the preponderance of the refining system to have unscheduled hiccups and problems is greater, as many of these refineries are 50, 60, 70 years old. And that is a concern. At the same time, of course, we have to look at the behaviors around the Russian deadline. I mean, February 5th today was a date that incentivized people to take as much Russian into the European system as possible before that was no longer acceptable. And I think looking at the behavior of Russian refiners, the margin is such that if they can export maximum products, I think they will. Of course, they have to make a calculation every time there's a negotiation that they're able to have as to how big the discount is on crude and how big the discount is on the refined product in the new world that we've now been served up as of yesterday. But overall, refiner margins are astonishingly good still and looking relatively resilient. I mean, it's been a long time since I've seen gasoline cracks as strong as this in January, February. And for distillate to be holding in the 30s and at times in the 40s above Brent dollars per barrel is a pretty special, pretty proud level as well. So it doesn't reflect recessionary fears or fears of some sort of demand implosion. It reflects a world where some are expecting close to 2 million barrels a day year-on-year demand growth for refined products, with diesel leading the way, and the overhang of very great concerns that maybe the world will not be seeing quite as much Russian, and maybe the very large diesel exports that have been coming from China have also some downside if the Chinese demand accelerates. And then the last thing we have to bear in mind is, as Christoph already indicated, if the world is going to have to realign and redirect its refined products that come out of Russia from the Baltic and the Black Sea all the way to Asia, that's a much, much longer voyage. So you see a phenomenal stock build on the water, which accounts for or takes away the best part of a whole month's worth of exports. And that's another form of demand. And then if you overlay on top of that, the potential headaches that maybe the market can't absorb all the Russian under the new February 5th directives that we've only just seen as of yesterday. I think in most companies, the legal and compliance divisions are still plowing through the small print. It is possible to envisage that there'll be even more stock build on the water as people park that oil on ships awaiting news whether or not.
Is that, Mike, why we're seeing this massive growth in what's called the shadow fleet of tankers? Trafigura, one of your peer group, has said it's up to 600 ships now in this sort of shadow dark fleet that is outside of the sort of oversight of regulation.
Yes, I saw the article that you sent us in the pre-read, Sean. I mean, it is definitely a number in the hundreds. I don't have the exact figure that was quoted in that particular interview, but
600.
You have, I think the numbers that were given are roughly 2/3 of that are crude, and it's a very substantial part of the global crude fleet, and 200 or 1/3 of those would be products, which is still less significant portion of the global clean product fleet. But yes, the point I was trying to make is if that fleet is not hurrying from A to B, but prevaricating and waiting around to see what rules permit people to bring oil to market, with insurance and banking systems able to pave the way for that oil to actually be discharged with a customer, presumably in Asia, then that fleet may serve as an on-the-water parking spot, awaiting further clarity on what people can and can't do.
Well, let's just pick up on that point, Mike. I mean, with the reflection on January, when Brent and WTI behind it tried to make its way up to the 90, while all of the financial markets were on a tear into the new year on Chinese optimism and so forth. But crude just didn't seem to have the legs. It started out the year, as we said earlier, where it is now. What's not in the demand cycle, do you think, that is giving oil the lift to where the financial markets in general seem to see the future?
I'm not too sure. I mean, I gave you 5 factors at the very
Yeah.
beginning of this chat, and I think yes, the move up from low 80s to high 80s was probably most supported by continued reassurance and confidence in Chinese demand for energy. And we've now seen potential, well, some indices that give you a view that the recessionary fears are on the wane. Good productivity data from China also, by the way, on top of the jobs data from the US. So honest answer is I don't know.
Looking forward, the reflection on the month past to the month ahead, as you said, the first full month of the China kind of reopening post Lunar New Year, clarity. We saw Asia as a whole looking quite positive on crude demand in January. Your outlook for the month ahead for that sort of momentum to build towards China and Asian demand?
Yes, I mean, it feels better than it did a short while ago. Just back to your price point, I mean, $80 is not a bad price for OPEC Plus, right? It's obviously, in some people's opinion, at the lower end of their preferred range, because we've seen rhetoric and even action whenever prices have dipped to this level or into the 70s indeed. But I think it's a price that works for most in a world that still has some elements of fragility to it. So, I mean, what do I say going forward? You've already mentioned refining turnarounds, but the major thing people are grappling with is now how these 2 new price caps that have been put forward by the UK, the EU, and a note from Janet Yellen, namely $45 a barrel for prices that trade products that trade below crude, and $100 a barrel for products that trade above crude. That's as specific as it was. How that actually gets translates itself into real action. Now, you mentioned crude. Crude is 2 months ahead of us because we had the $60 price cap for crude, which was roughly $20 below the crude market at the time, or $15 below where Urals was trading with relatively fewer impositions at the time. And we've seen how that panned out. As Christoph said earlier, most of that crude found its way to market with open arms in places like India and other countries, major economies in Asia. Whether that's the case for products as well, I've already mentioned that I think there will be an on-the-water stock build to the extent that uncertainty remains over what aspects of the supply chain are going to feel the pinch. And I need to emphasize this: the sanctions will not be on the buyer necessarily or on the seller. They will also impact in a big way the shipper, the ship owner, and also the insurance provider. And we've said this on numerous occasions in the past. The P&I clubs are largely bodies that are registered in G7 countries, many of them in the UK, if you remember, entities like Lloyd's of London, and then the various P&I agencies that spin off there, like Britannia. So these are the IG, as they call it, the international group, are the de facto providers of maritime insurance. The market now needs to scrape around for insurance providers that are not from G7, right? And the same goes for shipping. One of the responses of the market has been what you described as the fleet, seeing a portion of its fleets devoted to doing Russian trade. And then finally, there's the banking channels. We mustn't underestimate. There is a hesitancy I detect amongst Asian banks here in Singapore, certainly, right now, until there's further clarity from their legal advisors as to what the ramifications are if they start paying ultimately suppliers of Russian when new rules have been introduced by the G7 forbidding certain transactions. And we haven't yet mentioned the efficacy of the cap. I mean, if the price cap is observed, then G7 providers can be utilized. So it's fine to use a Greek ship and to use a British insurance company and to use a Singaporean bank, absolutely no problem. But we just don't know, because you need an attestation from the original supplier that that cargo was indeed sold at below $45 a barrel if it's something like fuel, or less than $100 a barrel if it's diesel. And we know that fuel is trading, depending on what quality of fuel, between $60 and $70 a barrel, and diesel is currently at more like 120. So many, many questions that the industry is going to have to address over the coming weeks. And whether or not His Excellency, the Minister of Saudi Arabia, is going to be proven right in suggesting this might result in less oil on the market remains to be seen.
Mike, last word to you to just follow through on that comment by Christoph on the price cap structure. We saw a story, we had it in the digest today, Indian refiners paying traders in dirhams for Russian oil coming out of the UAE. Is that a notable development? Your thoughts on that, sort of moving away from the dollar piece?
Dirham is
I
tied to the
don't-
dollar.
I know, but yeah, it's still settled in dirham. But it's,
I
yes,
think-
it is pegged.
Short answer, Sean. I don't think it's anything new. I think that's been happening for some time, and it's not new that Emirati and Middle Eastern banks have been able to act as conduits for those flows.